Hey, what's going on, guys? It's your boy Freddy. Welcome back to the channel. Today I want to do something a little bit different and go over a hypothetical portfolio that I believe has a lot of potential for both growth and for dividends. This portfolio will be pretty diversified through the major industries and will give you the option to swap around and change stocks as you see fit. Before you begin investing, there are a few things that you should consider. Number one being your financial fitness. This basically means how much debt and high interest liabilities that you do have at the moment. So for example, if you had a high interest rate of around 20% on a line of credit or something like that, then it would actually be better for you to pay that off, as you're getting an instant 20% return every time you pay it off compared to investing that in the market. Number two being your time horizon, or how long you have before you begin to draw down on your portfolio. So this takes into account things like your goals and how much money you're gonna be wanting to take out every year from your portfolio when you do decide to retire. Number three is the type of investor you want to be, as well as your risk tolerance. So are you gonna be able to stomach big drops in your portfolio and a lot of volatility? Or are you someone that wants slower and steadier growth with the trade-off that you may not see the great returns of having a lot of risk in your portfolio? Once you have all of these things considered, you can start to build out a portfolio that meets all your points and can start to put money in on a consistent basis. So today I'm going to go over a portfolio of only Canadian stocks that I believe has a lot of potential for growth and dividends to come. And this is the type of investing that I like to do on Wealthsimple, as there are no fees associated with investing and there are no commissions. So this means that I can dollar cost average to an extreme extent and not worry about any extra fees tacked onto my account. This is an extremely valuable tool, especially for small accounts, as the large fees that many Canadian banks charge are absolutely astronomical. So for example, if you put in $100 into the market, you would be charged on average $9.95 just to place your trade. And considering that the market on average returns 10%, that means you're instantly losing a year of your investing because of the fees. So for those of you just starting out, I would highly recommend using Wealthsimple and buy specifically Canadian stocks, as you don't have to worry about all of these commissions and fees and can instead buy high quality companies that have proven track records and a lot of dividend growth ahead. Looking at the markets today, we can see that most of the major indices are at or near all-time highs. And the question arises, is this a good time to invest in the market, or should we wait for more of a dip buy opportunity? Every time this thought crosses my mind, I like to look at this article that shows that since 1950, roughly 1 out of every days the market is open, or 6.7%, the market has closed at a new all-time high, and the S&P specifically has spent roughly 32% of its life within 5% of the all-time high. This to me shows that we'll never be able to truly time the top of the market or the bottom of the market, and instead should just invest consistently to ride out all of the highs and lows in the hopes of having a nice return that the market has already seen in the past. How much money you start with really depends on how comfortable you are with investing. I believe that having a consistent number that you can choose to reach every month that doesn't impact your quality of life in a major way is a good rule of thumb. Some people think that investing every dollar you have in the market right now in the hopes of having a better life in the future is the way to go. But personally, I believe that having a good balance, just like with anything else in life, is the key to success. The number of stocks in your portfolio really depend on how much time you want to devote to investing. If you want a set it and forget it type of approach, then I would highly recommend using ETFs or exchange traded funds, as they allow you to invest in hundreds of companies under one ticker and can really help you diversify. The number of stocks you want to hold in your portfolio really depend on how much time you want to devote to investing. If you're more of a person who wants a set it and forget it type of approach, I would recommend ETFs or exchange traded funds, as they allow you to invest in hundreds of companies under one ticker and can really help you diversify without having to do a lot of managing within your portfolio. If you have more time on your hands, I would still recommend ETFs, as they do help you to diversify extensively. But for individual stocks, I'd say around 7 to 12 is a good number, where you can have a lot of high conviction in those companies and have a strong understanding of the business model and how much growth there is ahead with those companies. The first stock that I want to go over is Bank of Nova Scotia, which is a Canadian bank, and it is an essential company for almost any Canadian investor. They're an extremely established bank in Canada and have been paying a dividend for well over 100 years. They're known as one of the 5 big banks and have a market cap of over $75 billion. They differ from some of the other major Canadian banks, as they have more exposure to emerging markets in countries in South America. This emphasis on developing countries has helped them to become a big name over there, and their exposure will only continue to grow as these countries continue to develop. Currently, BNS has a dividend of $3.60 per share, which is extremely solid as that represents a 4.6% yield when looking at the current share price. This dividend is growing at a very solid 5.3% over the last 5 years. BNS is trading at a bit of a richer valuation right now as earnings were a bit down in 2020. However, for a long-term investor, I see myself dollar cost averaging in on a consistent basis and enjoying the dividends as they come. You honestly can't go wrong with investing in any of the major banks as they are pretty similar in growth and they follow a similar trajectory. So if you are looking to just invest in the sector as a whole, you could invest in an ETF like ZEB, which tracks the overall industry. Next up is TransCanada Energy. TransCanada Energy operates as an energy infrastructure company operating through Canadian, US, and Mexico natural gas pipelines, as well as liquid pipelines and power and storage segments. This company builds and operates a massive network of pipelines that transport roughly 25% of North America's natural gas demands. They are a well-established company with an amazing dividend at almost 6%, and because of this very solid dividend, you are looking at overall slower growth in terms of the stock price as the company looks to pay out a majority of its earnings to shareholders. However, TC does aim to grow its dividend at an average annual rate of 8 to 10%, which shows just how committed they are to their shareholders. Looking at their earnings, we can see that they were able to adapt to the pandemic very well, as although they did see a reduction to their revenue, they were able to cut their costs and actually saw massive growth in their net income. As an income earning stock, TransCanada is right up there with real estate investment trusts and should be looked at as a go-to in any Wealthsimple dividend portfolio. The next stock that I feel that should be a part of a Canadian dividend portfolio is VFV. This is an ETF that tracks the top 500 publicly listed companies in the US. Now you may be wondering why I have added VFV to this hypothetical portfolio, and the reason is that it has massive growth potential. Although this portfolio is primarily focused on dividends, having a certain allocation towards growth is very essential as it allows you to take advantage of bull periods in the market without being fully reliant on selling shares when it comes time to draw down on your portfolio. VFV specifically is a great ticker to take advantage of this growth as the S&P, which is what this ETF mimics, has returned on average 10%. This means that this portion of your portfolio has the potential to see this type of return, which is absolutely amazing. The next stock that I want to go over in this portfolio is Telus. This is a telecommunication giant that has seen a lot of growth over the last few years and still has a lot of growth potential ahead. I really like the future of the telecommunication industry as the demand for internet and communication will only continue to grow. And as Telus remains as one of the largest companies in the industry, I expect the growth for the stock and the dividend to remain high. This company has a lot of potential to grow, especially in the home and business security space. They currently have around 700,000 security customers, and given that the option to have your internet, phone, mobile, and now security all under one company and have it work seamlessly can attract a lot of customers, I believe that this company should continue to see the great growth it has had over the last few years. Over the last 10 years, the dividend has grown on average 9%, which is amazing, and currently has a 4.8% yield. For what the company offers and the extensive history of paying out a dividend, Telus should definitely be a go-to in your dividend growth portfolio. Well, that is just a few of the Canadian dividend stocks that I believe should be added to a potential portfolio. There are a few companies that I am missing to fully round out the portfolio, like Algonquin Power, which is in the energy as well as the renewable industry, as well as CNR or Canadian National Railways, which is in the transportation industry. And if you guys are looking for a more in-depth analysis on those companies and really any company that I mentioned in this video, I will have a bunch of videos linked in the description to help you out. Remember to hit that like button down below as it really does help the channel to grow, and also consider subscribing for more investing videos like this to come. I'll catch you guys in the next one.